You ever see a company that just looks like it's absolutely crushing it? Reporting these huge profits, expanding everywhere, getting all this amazing press, and then, out of nowhere, it just collapses into bankruptcy. It seems completely impossible, right? Well, today, we are going to solve that exact mystery. We're going to dive into that dangerous gap between what a company says its profits are and the actual cash it has in the bank.
And look, this isn't some trick question. This actually happened. It's the real story of W.T. Grant, a massive U.S. retailer that back in 1973 looked incredibly healthy on paper. But believe it or not, it was just 2 years away from total liquidation. So how does that even happen? Well, the answer is buried in a fundamental conflict right at the heart of finance. And that brings us to what we call the profitable bankruptcy paradox. Yeah, it's a mouthful, but it's a real thing. It's a situation where a company's reported success, its profit, is telling a completely different story from its ability to actually survive, day to day. And to really get this, we have to start with a core principle that every forensic accountant basically lives by.
Okay, you got to remember this one. Forensic accountants have this mantra: profit is an opinion, cash is a fact. And that's not just some catchy phrase. Profit or net income, it's the result of a whole bunch of accounting rules, assumptions, and estimates. It's a really sophisticated number, for sure, but at the end of the day, it's an interpretation of performance. Cash, on the other hand, it's undeniable. It's the money in the bank. It's what you use to pay your employees, your suppliers, and keep the lights on. It is reality.
So the key to solving our whole mystery is understanding that profit and cash are basically speaking two different languages. And the gap between them, this huge schism, that's where these healthy-looking companies just fall right into the abyss. And it all starts with how we decide to measure business activity in the first place.
Now look, this isn't to say accrual accounting is bad or anything. It's the global standard for a reason. Its whole goal is to match up revenues with the expenses it took to earn them, which gives you this nice, smooth picture of long-term performance. It records a sale the second it's earned, like when you deliver a service, not when the customer actually, pays you. Cash accounting is way simpler. You only record something when money physically changes hands. That tiny difference in timing and philosophy, it is everything.
And what's really fascinating here is how it lays out the different goals. The accrual method, that's what gives us net income. It's designed to show long-term profitability. It's asking, hey, are we building value over time? But the cash method, which is all about cash flow, it's about immediate survival. It asks a much more urgent question: can we pay our bills today? And when the answers to those two questions start to drift apart, you are in serious trouble.
So if a company is profitable, where in the world is all the cash going? It doesn't just vanish into thin air. No, it gets trapped. And the primary scene of the crime, if you will, is something called working capital.
Think of working capital like this. It's the money a business needs to fund that gap between when it spends cash and when it receives cash. For example, you spend cash today to build a product. That product sits in a warehouse as inventory. Then you sell it, but your customer has, say, 60 days to pay you. For that whole time, your cash is just stuck. It's trapped in the day-to-day operations of the business. And as these things grow, they can silently suck a company completely dry.
Okay, let's look at this table. When your accounts receivable go up, that means more customers owe you money. Your net income looks fantastic because you've technically earned that revenue. But your cash flow, it's negative because nobody's actually paid you yet. Same thing with inventory. Buying a ton of extra stock doesn't hurt your profit right away, but man, it's a huge cash outlay. So here's the crucial point. The very things that make a company look like it's growing can be the exact things that are draining its cash reserves. And all of this leads to this really dangerous paradox called the growth trap. This is where a company's success becomes its own worst enemy. You're growing so fast, you're hiring people, buying inventory, opening new stores, that the cash you're spending to fuel all that growth is way, way more than the cash you're actually bringing in from customers. Profitability looks amazing on paper, but you are running out of fuel, fat.
All right, so let's see how this so-called growth trap actually plays out in the real world. I mean, these aren't just theories. These principles have brought down absolute corporate giants. And we're going to start by going back to our first case, W.T. Grant.
And this just perfectly illustrates the disconnect. So in 1973, W.T. Grant reported a very respectable $38 million in net income. And even a common cash flow estimate they used back then, which adds back non-cash expenses like depreciation, which is really just an accounting trick to spread out the cost of a big purchase over time, that suggested they generated $48 million. But
that's right, negative $120 million. That was their actual cash flow from operations. All that reported profit was a total mirage. It was created by super aggressive expansion and a disastrous in-house credit card system that left all their cash tied up in unpaid customer bills and warehouses just overflowing with unsold goods. The company was literally drowning in its own success.
Decades later, it's the exact same story. The huge UK contractor Carillion looked profitable because it was booking revenue on these massive long-term projects way before the money was actually in the bank. To survive, it started desperately stretching out payments to its own suppliers, sometimes up to 120 days, and borrowing money just to pay dividends. This dash for cash was a fatal symptom of a business that was profitable only in its accountant's spreadsheets.
And yeah, even a beloved brand like Krispy Kreme fell right into this trap. They doubled their store count, tying up 70% of their entire net worth in buildings and equipment. And to keep Wall Street happy, they started doing something called channel stuffing, basically forcing their franchisees and supermarkets to take way more donuts than they could possibly sell, just so they could book the revenue early. This whole scheme masked the fact that real sales were declining, and the company was hemorrhaging cash just to keep up the appearance of growth.
So, how can you spot this before it's too late? Well, the good news is that financial analysts have a toolkit they use to see right through the illusion of profit and find the reality of the cash situation. So let's open up the kit and look at the key tools.
This right here is probably the single most important reconciliation in all of finance. Analysts build what they call a bridge to get from net income to something called free cash flow. They start with the profit number, then they add back those non-cash expenses like depreciation, which remember is just an accounting thing, not real money. And then, this is the crucial part, they adjust for all those changes in working capital we talked about. This whole process strips away all the accounting opinions to get to the cold, hard cash fact.
And once you have that real cash flow number, you can calculate something called the cash conversion ratio, or CCR. This thing is an incredibly powerful diagnostic tool. It answers a simple question. For every dollar of profit you claim, how much actual cash did you generate? If a mature company is consistently showing a ratio below 1.0, it means its profits aren't turning into cash. That is a major red flag. It's signaling that either there are serious operational problems or the earnings themselves just aren't high quality.
At the end of the day, it all comes down to this. The income statement, the thing that gives you profit, it's like a map. It shows you where the company hopes to go. It's the vision, right? The long-term plan. But the cash flow statement, that's the fuel gauge. It tells you if you actually have enough gas in the tank to make the journey. And as we've seen, you can have the most beautiful map in the world and still end up stranded on the side of the road.
So the next time you read a headline about a company's record-breaking profits, you'll have the tools to look a little deeper. Because now you know that the most important question you can ask isn't just, how much money did they make? It's, yeah, but where's the cash?